About a week ago, here in my Robinhood portfolio, I decided to pick up 29 shares of Realty Income stock, making it one of my largest holdings here in my portfolio. And I love this company because they actually pay you monthly dividends. So I get $7.61 every single month just for holding onto my shares. And that's for 29 shares. I plan to increase my shares slowly, but this company actually has a history of raising their dividends. So, matter of fact, in this year, so just in the trailing 12 months, this company has risen their dividend 3 times. This company is also a member of the S&P 500 and they're a dividend aristocrat, which means they've risen their dividend for over 25 years, even through 2008 and 2020, which were some very tough times. This is a very solid company that does a triple net lease structure, and they're also the real estate investment trust, so they actually have to pay out this dividend. They have a very high dividend yield, around 6% right now, and it's actually very sustainable, and I'm going to show you why this company actually has a room to raise the dividends. But don't just take my word for it. I'm going to show you the numbers for yourself so you can see exactly how much room they have to raise the dividend. So check this out. They have a huge market cap of $46 billion. There's a lot of safety in a high market cap, and they have a dividend yield of 5.91%. And if we look to the left of that, they have a PE ratio of 49. So a lot of new investors look at the PE ratio and think that that's an appropriate metric you look at for a REIT. That's an appropriate metric you'd look at for any other stock that's not a REIT or an MLP or a BDC. But for these REITs, you never look at EPS because that's a multiple on their net income, and you don't look at net income. You actually look at the AFFO or the core FFO, which is this number down here. It's $778 million. And check out this number. Remember that number, $778 million is how much they made, and their dividend cost $639 million. So if their dividend cost $639 million, let's see how much net income they made. They made $133 million of net income. They've never been able to afford that, so of course you never look at the net income for a REIT. And let's actually check out their total revenue growth. It's actually up 33%, which is very impressive. That's because they've grown their assets like crazy. 1 year ago, they only had $51 billion of assets. I say only, that's a huge amount. But it went from $51 billion to today $68 billion while staying at the same assets to liabilities ratio, which is super impressive. It stayed at that 42%. And here's their dividend history. If we look at the most recent month, it was 0.26. The month before, it was only 0.25. So they actually just rose the dividend in the most recent month. And if you scroll down, they have a huge history of raising their dividend. Like I said, they're a dividend aristocrat. They raise their dividend every single year. But we just times this number by 3 because this is monthly. So we can see how much their dividend cost every single quarter on a per share basis. So 0.26 times 3, we can just round that up to around 80 cents. So their dividend cost 80 cents every single quarter. Well, here was what Realty Income just announced 2 days ago. They announced an increase in their AFFO guidance from $4.13 a year to $4.15. Now, that's not a huge increase, but that shows a lot of confidence that they're actually going to hit their numbers and not miss. So $4.15, if you divide that by 4, that's well over $1 of AFFO per quarter. And remember, their dividend cost 80 cents, so that's around an 80% payout ratio. Actually, no, that's not, because I wasn't accounting in for the 15 cents. So they really have like a 75% payout ratio, something along that. We could calculate the exact numbers, but I also want to take you guys through Realty Income's investor presentation because this is also super impressive. This is the most recent presentation that they have of May 2024, so we get to see what are the most recent updates with the company. Like I said, this company is inside the S&P 500 and a dividend aristocrat, and they have a credit rating from Moody's and S&P Global, and not just any rating, an A rating, which is basically the best rating you can have. And they're also the 6th largest global REIT, so not just in the USA, but the 6th largest global REIT, which is super impressive, and 646 monthly dividends declared and 106 consecutive quarterly increases. So if you times this by 3, that's how many consecutive quarterly months increased. That's a little weird, but this isn't the most recent quarter, so this was the old guidance, so it was $4.13. Remember, just 2 days ago, they rose it to $4.15, so this is where they found the old guidance right here. Pretty cool that we can actually go and find the numbers when we dig into it. So they give some other highlights here as well. So they say a first quarter investment volume of $38 million in a U.S. data joint center. So data centers right now is an industry that is really booming, and I like that Realty Income is investing into this. They actually are doing this is with Digital Realty Trust, ticker symbol DLR. So they're kind of doing like a collaboration with them, which is pretty cool. And you can pause and read all of the other highlights. But let's actually scroll through a lot of the other pages and see what they have to say. So they have a track record of attractive total returns through consistent earnings and dividend growth. Here are the highlights that I found about this page, which I think is really cool. They have a 5.7 median AFFO per share growth. So the per share growth includes all of the acquisitions that they do, because if they dilute you as a shareholder, it's included in the per share metric. So this is the most important highlight that I think, in my opinion. And they have a compound annual dividend growth rate of 4.3% since 1994. So the farther you go back, the better. And of course, they're part of the Dividend Aristocrats list, which means they're just super, super safe. And you guys remember how Realty Income was expected to make $4.15, or they just rose the guidance? Well, here in the trailing 12 months, they made $3.98, and today's multiple on that number is a 13.4. This is what I like to look at as a PE ratio. So remember, we looked at the normal PE ratio of 44, and the forward PE ratio was a 39. You don't look at that metric. The AFFO multiple of the company is a 13.4, and that's based off the trailing 12 months AFFO of $3.98. They're now expected to make $4.15, so there's going to be valuation compression. So that's why I really like, in my opinion, remember, none of this is financial advice. That's why I really love Realty Income, and that's why I own them, and that's why they're on my t-shirt as well, if you can see that. Man, all right, so we also got to address another thing about the company, and that's their balance sheet and their amount of debt. So this company has a 5.5 net debt to EBITDA, and here's what I really like about the company, is that they have a very conservative long-term debt profile, with 94% of their debt at locked-in fixed rates. If you had your debt at floating rates, which means it's whatever the market is right now, as we know, interest rates are very high, so having interest rates at fixed rate is a really good thing. And also their debt to total market cap of 36% is very safe. Of course, they're A3 rated from Moody's, A- from S&P Global. These are both publicly traded companies you can invest in, ticker symbol SPGI. And I forget Moody's ticker. Is it ticker symbol MDI? I don't know, but here is their diversified high quality portfolio. So all of these ones that are in orange here are actually also rated from Moody's and S&P Global. So all the ones that are orange rated have a credit rating of B- or above, which is pretty cool. We can also see the industry diversification. So 10% of their money comes from grocery stores, then convenience stores, which are like they're your 7-Elevens, Then you got dollar stores, home improvement, drug stores, and a very diversified portfolio, which I really, really love. And they're also diversified geographically, because check this out. I really noticed that 11% of their portfolio is in the United Kingdom. And then 10% is in Texas and Florida and California. These are all very popular states that I really like. Did y'all hear Texas might be getting their own stock exchange, like the Texas Stock Exchange? That's pretty cool. But here's how they said that they're insulated from changing consumer behavior. They're service oriented. They have all different kinds of properties. They have Walmarts, they have Sam's Clubs, they have MGM Resorts, Wynn Resorts, FedEx, Tractor Supply Co. These are all very high quality tenants. I guess Red Lobster is a little bit in the toilet right now, but luckily Red Lobster makes up 1.1% of their portfolio, which is very, very tiny. And I think everything's going to be okay with them, because this is also their occupancy. The median of the S&P 500 REITs are in the blue, and Realty Income is, of course, the orange. And today they have an occupancy rate of 98.6, which is very, very impressive. This line is like the average right here. During 2008, 2009, it fell down to 96%. So if we know something bad happens again, their occupancy will literally drop to 96%, which 96% is still super impressive. That's crazy. And here's another really cool thing that I like about Realty Income. Because they're a huge size, they have the capacity to buy in bulk at wholesale prices while maintaining diversification. So they say peers with smaller denominators, so the smaller market cap REITs. Remember, they're the 6th largest global REIT in the whole world. All the other smaller ones lack the ability to buy in bulk without incurring material diversification risk. So that means maybe 20% of their entire portfolio is in one industry or one tenant, which you wouldn't really like. So Realty Income is really nice for being very, very diversified. and they have a superior status over the S&P 500 REITs. So in the S&P 500, there are a few other REITs, and here are the average of all of the other REITs. So at the bottom, it includes all them if you want to read it, but they have a historical median occupancy rate of 98%, and the average REIT has 95%, and the low year end of 96%. So on a good year and a bad year, 96% and 91%. And over here is another something super impressive. Years with negative growth, negative dividend growth. Average REIT has 10%, and there is zero. They've never had one. In the dividend compound annual growth rate of 4.3%. They also visualize it down here, the average rating of the REIT, and here are all the ratings of REITs with the A- to A3 rating, and Realty Income is right there, and there are all the other ones. None are above that, I don't believe. And Realty Income is investing heavy right now in Europe. Check this out. They have continued to grow their European presence with investment of $10.4 billion through March 31st, 2024, which is pretty crazy, with 459 properties. And here are their top tenants. Let me know if you've heard of any of these. I hear this one right here is a very popular company, and over there like a popular grocery store. But yeah, that's pretty much all I wanted to tell you about this video. If you enjoyed how I broke down all the numbers, please hit the like button. I would really appreciate it. That's my entire portfolio. I'm always transparent when I do portfolio updates. Here are all my holdings, of course, and check out my previous video actually.